Now, trade deal between the United States and South Korea is in a flux following Donald Trump's demand for a $350 billion upfront investment.
South Korea says it is unable to pay $350 billion upfront to the US under a tariff deal proposed by Donald Trump. The country is now looking for an alternative.
South Korea's president warning of potentially devastating effects tied to the country's trade deal with the U.S. Speaking with Reuters, the Korean president saying his country's economy could fall into crisis like the one it faced in 1997.
South Korea says it is unable to pay $350 billion upfront to the United States under a tariff deal proposed by Donald Trump. The country is now looking for an alternative. Now, the trade deal between the United States and South Korea is in a flux following Donald Trump's demand for a $350 billion upfront investment. South Korea's president is warning of potentially devastating effects tied to the country's trade deal with the U.S. Speaking with Reuters, the Korean president said his country's economy could fall into crisis like the one it faced in 1997. Factories were supposed to roar back to life. Cities were supposed to thrive again. And foreign money was expected to pour into the United States. That was the promise behind Trump's tariffs, a bold strategy to spark a new industrial revival. Yet the reality unfolding is far less triumphant. In July, Washington and Seoul announced a framework that could have sent $350 billion in South Korean investment into the U.S. economy, tied to a rollback of certain tariffs. Months later, that pledge remains little more than words on paper. And South Korea is not the only one holding back. Across Europe and Asia, grand investment announcements are stalled with little sign of becoming real factories, jobs, or paychecks. The hesitation grew even louder after a shocking raid in Georgia, where foreign workers were arrested in a move that left investors questioning whether America is still the dependable partner it once claimed to be. If confidence continues to slip, who will be willing to place their bets on America's future? And how much longer can Washington hold onto the illusion of a comeback? In South Korea, the fallout from what happened in Georgia has not faded. Earlier this September, hundreds of engineers and technicians from Hyundai and LG arrived in the United States to help bring one of the largest battery projects in the country to life. Instead of recognition for their role in building a state-of-the-art facility, they were suddenly rounded up in an immigration raid. More than 300 workers were forced onto a plane back to Seoul, escorted home with no charges, no clear explanation, and the bitter memory of being treated as criminals. Families watching their return described it as humiliating. Executives in both companies saw something else, a warning sign that their billions of dollars in investment might not be welcome. The timing could not have been worse. Only weeks earlier, Washington and Seoul had unveiled a plan that, if successful, would have reshaped economic ties for years to come. The arrangement was simple on the surface. The United States promised to cap tariffs on Korean goods at 15%. In exchange, South Korea would channel an extraordinary sum, $350 billion, into American industries. It was supposed to be a landmark moment, a deal that symbolized mutual trust and ambition. Yet, by the time those engineers were deported, the entire framework had stalled. The South Korean president himself made it clear that such a massive outflow of capital could not be risked without a financial backstop. Without a currency swap to shield Seoul from sudden shocks, the transfer of funds could put the Korean economy on the edge of a meltdown like the crisis of 1997. Until those guarantees are in place, the money will stay where it is. The Georgia raid turned hesitation into alarm. What was supposed to be a story of opportunity had become a lesson in risk. South Korea is not alone in this. Europe too has been caught between the promises of Washington and the reality of delivering capital. In September, American and European leaders announced a sweeping agreement. Tariffs capped at 15%, accompanied by pledges of $600 billion in European investment by the end of the decade. On paper, it looked bold and historic. In practice, the details remain vague. Who will provide the money? Which governments or corporations will step forward? When will the first projects actually begin? None of those questions have been answered. Across Europe, the public mood is skeptical. With inflation still high and many countries facing their own budget strains, ordinary citizens are asking why their capital should be sent abroad while their own economies struggle. Without clarity and political will, the so-called breakthrough looks more like a headline than a turning point. The hesitation in Seoul and Brussels makes Canada's path even more revealing. Unlike Europe and South Korea, Ottawa has not rushed into grand announcements with Washington. Instead, Canada has chosen to concentrate on itself, directing resources into critical mineral projects, new pipelines, port expansions, and housing. Each of these efforts signals stability and long-term planning. For global investors looking at North America, the difference is becoming more obvious by the day. While American policy creates turbulence and anxiety, Canada is presenting itself as a steady and secure environment for capital. It has avoided bold promises that may collapse under scrutiny and is building credibility through projects already underway. This contrast highlights a broader trend. The tariff strategy that was meant to revive American strength has produced the opposite effect. Announcements of hundreds of billions in future investments sound impressive, but the follow-through is weak. What was supposed to reassure American workers has instead left allies doubtful. By mid-2025, independent studies confirmed the damage. Reciprocal tariffs reduced growth in the United States, fueled inflation, and made investors think twice before committing capital. Combine that with immigration raids and financial demands seen as destabilizing, and the outcome is inevitable. The United States has gained headlines but lost trust. Without trust, foreign direct investment, the very lifeline needed to rebuild industry, remains elusive. The raid in Georgia is perhaps the clearest example of how that trust has unraveled. The scene was dramatic and unsettling. Helicopters circling overhead, armored vehicles on the ground, and more than 300 skilled professionals marched away in handcuffs. These were not illegal workers seeking under-the-table jobs. They were specialists brought in under visas, essential to building a multi-billion-dollar battery plant that was supposed to symbolize partnership between two allies. Watching them return home with their belongings in plastic bags struck a nerve across South Korea. What could have been celebrated as progress turned into a reminder of vulnerability. The political fallout was immediate. In Seoul, the outrage crossed party lines. Conservative newspapers, usually aligned with the American alliance, warned that South Korea's entire investment strategy might have to be reconsidered. Families of the detained workers wept on camera, demanding accountability. For a society where national pride and corporate prestige are deeply intertwined, the image of elite engineers treated like criminals was deeply offensive. Washington, sensing the backlash, scrambled to respond. A senior American diplomat was dispatched to Seoul to express regret. President Trump posted a statement online assuring that foreign companies remained welcome and their workers would be allowed to train Americans. But his words only deepened the unease. His phrasing suggested that Korean experts would be phased out after teaching Americans their skills. In South Korea, many took that as a sign that their people were seen as temporary tools, not respected partners. Protests erupted in Seoul with banners asking whether America could still be trusted. Social media campaigns demanded lawsuits against the U.S. government and urged LG and Hyundai to take a firmer stance. Some even called for retaliatory measures against American workers in Korea. Instead of repairing ties, Washington had sparked anger and suspicion. The problem is larger than one raid. It reflects a deeper contradiction in American policy. On one hand, Washington is demanding that allies commit vast sums, hundreds of billions of dollars in new investment in order to gain tariff relief. On the other, it is enforcing immigration crackdowns that target the very workers needed to make those investments successful. This dual message makes America look unpredictable and unsafe. For South Korea, the Georgia raid confirmed the risks of channeling too much capital into the United States. For America, it shattered the claim that the country is open for business. In global economics, confidence is as valuable as cash. Once it is shaken, it takes years to rebuild. The lesson is clear. Tariffs, raids, and pressure may produce short-term political victories, but they do not create an environment where allies feel secure. The engineers detained in Georgia were supposed to help build one of the most advanced factories on American soil. Instead, their treatment has become a symbol of mistrust, a turning point where a key ally began to question whether cooperation with Washington is worth the risk. What was meant to be a show of control ended up being a warning to the world. Policies built on confrontation are pushing investment away rather than pulling it in. Partnerships that once seemed solid are showing cracks, and the image of South Korean engineers in handcuffs may be remembered not as a triumph of strength, but as the moment America's strategy backfired. Now to the latest on President Trump's war on wind power. In late August, the administration ordered construction to halt on Revolution Wind, a nearly completed offshore project off the coast of New England. At a cost of $6 billion with 65 turbines planned, the development was designed to supply clean power to 350,000 homes. Years of planning, Nearly a decade of permits and reviews, and the laying of submarine cables had brought it to the finish line. More than 80% of the work was already complete. Yet with a single order, the project was frozen in place. Connecticut and Rhode Island responded with lawsuits, arguing that Washington had no legal basis for the decision. Their attorneys general accused the White House of unraveling years of regulatory certainty overnight. Local leaders warned that the consequences were not abstract. Workers who had expected steady paychecks through the following year were suddenly left without jobs. Families facing some of the highest electricity rates in the nation were told that cheaper power would remain out of reach. Offshore construction ships, cranes, and crews were sent home while millions in equipment sat idle in the water. For many in New England, the suspension was more than a financial hit. It was a blow to confidence in the future of clean energy. Revolution Wind had been built as a flagship for America's renewable ambitions, proof that offshore projects could compete on scale with fossil fuels. Contracts signed in 2019 locked in prices at under 10 cents per kilowatt-hour for 20 years, far lower than the retail average in southern New England. The region's grid operator, ISO New England, had made it clear that new wind power was essential to replace coal retirements and supplement limited gas supplies at the end of strained pipeline networks. Instead of delivering stability, Washington's reversal cast doubt on whether any developer could risk billions in a sector where political decisions can erase years of investment overnight. That doubt becomes starker when compared with Canada. While American policy puts projects in limbo, Ottawa has declared offshore wind a national priority. In Nova Scotia, federal and provincial governments are working together to build up to 5 gigawatts of capacity by 2030. Transmission planning is already tied to future hydrogen facilities, and environmental approvals are in place. Canada has created a special projects office to accelerate reviews and has pitched offshore wind as a cornerstone of its energy transition. The difference is striking. One nation is dismantling confidence in renewables while its neighbor is accelerating them. The outcome could shape which country attracts investment, secures cheaper electricity, and leads in new export industries. The pause on Revolution Wind illustrates a broader divide. On one side are the promises of new jobs, affordable power, and grid stability. On the other is a White House that dismisses wind and solar as unreliable, pointing to cloudy skies or calm seas as proof of their weakness. But the evidence in New England tells another story. The halted project embodied lower rates, stronger supply, and thousands of well-paid union jobs. The administration's decision was not only about turbines in the Atlantic. It was about the credibility of America as a destination for energy investment. If nearly finished projects can be undone by a single directive, future proposals may never get off the drawing board. This theme of disruption carries into another front of policy, metals. When President Trump announced a 50% tariff on imported copper products, he framed it as a defense of national security. China, the largest global supplier of refined copper, was the stated target. The measure, enacted under Section 232, was supposed to shield America's industry. Instead, the first shock waves were felt inside the United States itself. Futures markets swung violently. Prices for copper in New York surged to a record gap against London trading, climbing 31% higher. Rather than stabilizing the industry, the tariff fueled volatility for manufacturers. The new costs squeezed margins across appliances, vehicles, and electronics. Copper is the backbone of wiring and modern infrastructure. So any surge feeds directly into higher production costs. Instead of strengthening competitiveness, the tariff cut into it. The results are impossible to ignore. America is idling ships off its coastline, discarding cheaper electricity, and fueling theft across its communities. Canada is moving toward becoming a clean energy hub and positioning itself as a reliable source of copper, minerals, and renewable power. China, far from being sidelined, is finding new ways to embed itself in the American market. A strategy designed to project control is instead amplifying uncertainty. To understand how we got here, let's step back and examine the historical context of these trade tensions. The relationship between the United States and South Korea has long been shaped by economic interdependence and strategic alliances. Dating back to the Korean War in the 1950s, the U.S. has been a key military ally, and this partnership extended into trade with the Korea-U.S. Free Trade Agreement, or KORUS, implemented in 2012. Under the first Trump administration from 2017 to 2021, that agreement was renegotiated, introducing safeguards for U.S. automakers and adjustments to steel quotas. But in 2025, with Trump back in office, the approach has escalated. The proposed deal this July aimed to lower U.S. tariffs on Korean imports from 25% to 15%, but only in exchange for that massive $350 billion investment pledge. According to reports from Reuters and Bloomberg, South Korean officials have repeatedly stated that paying this sum up front is impossible without risking financial instability. President Lee Jae-myung has drawn parallels to the Asian financial crisis of 1997, when South Korea faced a severe currency devaluation and had to seek an International Monetary Fund bailout. Analysts warn that diverting 84% of South Korea's foreign currency reserves could trigger capital flight, weaken the won, and spike inflation. This is not mere speculation. Economic models from think tanks like the Center for Strategic and International Studies suggest that without a currency swap line from the Federal Reserve, Seoul's economy could contract by up to 3% in the coming year. Adding to the complexity is the role of major corporations like Hyundai and LG. These companies have already committed billions to U.S. projects, such as the Hyundai Motor Group Metaplant in Georgia, a $7.6 billion electric vehicle factory expected to create 8,000 jobs. LG Energy Solution is partnering on battery production there, part of a broader push to localize supply chains amid global EV demand. But the September 4th raid by Immigration and Customs Enforcement disrupted everything. Homeland Security officials confirmed 475 detentions, mostly South Korean nationals on work visas. Wikipedia and news outlets like CNN and the New York Times detailed how these workers, many engineers and technicians, were held without charges before being deported. The raid, the largest single-site action in ICE history, halted construction and sparked diplomatic outrage. South Korean media outlets, including the Korea Herald, reported protests and calls for retaliation, while families shared stories of humiliation. Hyundai and LG executives expressed concerns that future investments could be jeopardized if skilled labor faces such risks. This incident underscores a contradiction in U.S. policy, inviting foreign capital while cracking down on the workforce needed to deploy it. Turning to Europe, the parallels are striking. The US-EU Framework Agreement announced in August promised a reciprocal 15% tariff cap in exchange for $600 billion in European investments by 2028, plus $750 billion in U.S. energy purchases. White House fact sheets hailed it as a massive win, but European leaders and analysts from Politico and the Peterson Institute for International Economics have criticized it as unbalanced. Details on funding sources remain unclear, with no specific commitments from governments or firms. Public skepticism is high amid Europe's own economic challenges, including post-pandemic recovery and energy crises stemming from the Russia-Ukraine conflict. Inflation in the Eurozone hovers around 5%, and budget deficits in countries like France and Italy limit appetite for overseas spending. Think tanks warn that without enforceable mechanisms, the deal could falter, leading Trump to threaten higher tariffs, as he did in an August statement suggesting 35% duties if pledges are not met. In contrast, Canada's approach offers a model of stability. Ottawa has avoided flashy deals, focusing instead on domestic priorities. Investments in critical minerals like lithium and nickel support the EV boom, while pipeline expansions like Trans Mountain enhance oil exports. Port upgrades in Vancouver and Halifax improve trade logistics, and housing initiatives address affordability crises. On the energy front, Nova Scotia's offshore wind roadmap is ambitious, aiming for 5 gigawatts by 2030, enough to power millions of homes and export hydrogen. Government websites and reports from Offshore Wind Biz detail 5 designated areas for development, with the first bids in 2025. Federal support includes accelerated permitting and ties to green hydrogen production, positioning Canada as a clean energy leader. This steady progress contrasts sharply with U.S. disruptions, attracting investors wary of volatility. The Revolution Wind saga exemplifies American uncertainty. Ørsted's $6 billion project off Rhode Island and Connecticut was 80% complete when halted in late August by Interior Department order. Court challenges from states succeeded in September, with judges ruling the stop work order lacked legal basis, allowing resumption. But the damage was done. Hundreds of union jobs lost temporarily, equipment idled, and confidence eroded. PBS and AP News reported economic fallout, including delayed clean power for 350,000 homes at below market rates. ISO New England had counted on this to offset fossil fuel retirements, highlighting how political interventions undermine grid reliability. Similarly, The 50% copper tariff imposed in August under Section 232 has backfired. White House proclamations framed it as national security, targeting China's dominance in refined copper. But Bloomberg and CNBC documented immediate price spikes, with New York futures 31% above London benchmarks. Manufacturers in appliances and electronics face squeezed margins, passing costs to consumers and fueling inflation. Volatility has encouraged stockpiling and even theft, as communities report increased copper wire pilfering. Canada, with its own copper mines, benefits as a stable alternative supplier. Overall, these policies reveal a pattern: short-term gains at the expense of long-term alliances. Independent studies by 2025, including from the Tax Foundation and Size, show tariffs reduced U.S. growth by 0.5% annually, added to inflation, and deterred investment. Foreign direct investment inflows dropped 15% year over year, per Bloomberg data. Allies like South Korea and Europe hesitate, while Canada thrives. China adapts by rerouting trade through third countries, embedding deeper in global chains. The Georgia raid, wind halt, and copper duties symbolize a strategy that amplifies uncertainty rather than control. As trust erodes, the U.S. risks isolation in a multipolar world. Investors seek predictability, and right now, it's found north of the border or elsewhere. This raises profound questions about America's economic future. Can tariffs truly revive industry without alienating partners? Will immigration enforcement adapt to global talent needs? And how will energy policy balance security with sustainability? The answers will shape not just bilateral ties but the global order. For now, the illusion of a triumphant comeback fades, replaced by the reality of stalled promises and growing doubt. What do you think? Share your thoughts as we continue to monitor these developments. To delve deeper into the historical roots of these issues, consider the evolution of U.S. trade policy. Post-World War II, America championed free trade through institutions like the General Agreement on Tariffs and Trade, which evolved into the World Trade Organization. This framework fostered global growth but also led to imbalances, with manufacturing jobs shifting overseas. By the 20-teens, populist sentiments fueled a backlash, culminating in Trump's first-term tariffs on steel, aluminum, and Chinese goods. Those measures, totaling hundreds of billions in duties, aimed to protect domestic industries but raised consumer prices and invited retaliation. In 2025, the approach intensified with universal tariffs and massive investment demands. For South Korea, this echoes past pressures. During the 1997 crisis, U.S. support via IMF loans came with strings, including market openings. Today's demands feel more extractive, as per Fortune's analysis, potentially sinking the won and sparking outflows. President Lee's call for a Fed swap line harkens to 2020's pandemic measures, when such tools stabilized markets. Without it, risks mount. Hyundai's Georgia plant, meanwhile, represents the EV transition's challenges. The Inflation Reduction Act of 2022 incentivized North American production, drawing Korean firms. But visa issues for specialists highlight workforce gaps. U.S. training programs lag, necessitating foreign expertise. The raid, detailed in IEEE Spectrum, disrupted operations amid labor tensions, with unions pushing for local hires. This tension mirrors broader debates on globalization versus protectionism. In Europe, the deal's vagueness invites scrutiny. The World Economic Forum notes EU commitments to U.S. energy buys aim to reduce Russian dependence, but $600 billion in investments strain budgets. Countries like Germany, with its own EV push via Volkswagen and BMW, question diverting funds. Trump's threats amplify fears, per factcheck.org's verification of his statements. Canada's wind ambitions, supported by Marine Renewables Canada, integrate with net zero goals. Nova Scotia's 15-gigawatt target by 2040 could export power to New England, ironically filling U.S. gaps. This interconnectedness underscores policy ripple effects. On copper, White and Case alerts note the tariff's broad scope, hitting semi-finished products and raising costs for green tech like wiring in renewables. As Supply Chain Dive reports, it encourages diversification away from China but hurts U.S. competitiveness short-term. In sum, these events paint a picture of a nation at a crossroads. Bold actions yield headlines, but sustainable growth requires trust and consistency. As allies recalibrate, the U.S. must reflect: is confrontation building strength or sowing seeds of decline? Stay tuned for more insights on this unfolding story. Let's expand on the human impact of these policies, starting with the families affected by the Georgia raid. Imagine being a skilled engineer, leaving your home in Seoul for a prestigious assignment in America, only to be detained in a dramatic sweep. News footage from CBS and PBS showed tearful reunions at Incheon Airport, with workers carrying plastic bags of belongings. One technician told reporters it felt like being treated as a criminal despite valid visas. For Hyundai and LG, this means rethinking talent deployment. Executives in interviews with the chosen daily expressed fears of talent shortages delaying projects. Broader, it affects U.S. communities too. Georgia's Meta plant promised economic revival in Elable, but halts mean lost wages for local suppliers. Similarly, Revolution Winds workers in Rhode Island faced sudden unemployment. Canary Media reported crews sent home mid-shift, with specialized vessels idle at costs of millions daily. Families in high-cost New England areas struggle with bills, while promised lower rates evaporate. Lawsuits from attorneys general highlight state-federal clashes, with judges citing regulatory overreach. The copper tariffs effects ripple to everyday life. Higher appliance prices hit households, per CNBC analysis. Manufacturers like General Electric warn of job cuts if margins shrink further. In contrast, Canada's stable policies draw praise. Corporate Knights notes maritime provinces' momentum in wind, creating thousands of jobs without drama. Nova Scotia's roadmap, with federal backing, ensures community buy-in through consultations. This approach could model future U.S. efforts, if politics allow. Ultimately, these stories remind us economics is about people, not just numbers. As tensions simmer, dialogue may yet prevail over division. Thank you for listening to this in-depth exploration.